Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
The prospect of peace boosts risk appetite. Euro strengthens, oil drops, with Presidents Trump and Putin set to meet in Saudi Arabia. Charting the next steps, a U.S. delegation heads to Munich for a security conference and gears up for a meeting with President Zelensky. Close, but not there. Chair Powell says there's more work to do, bolstering the case for a Fed hold. Jobless claims, PPI, up next. Good morning, Manus.
Danny, good morning. Grappling with an extension in rates. This is the stock market this morning. We're just a hint of green on the NASDAQ. The deeper the dip, my favorite line from yesterday, the deeper the dip, the bigger the buy. Consumer staples actually boomed yesterday. Energy on the back foot. Of course, the question is on this weakness. You see the spike in the bond market, roll it over, have a look at it, because the bond bears hit the sell button. We pop by 10 basis points. How hot is hot on the CPI? We can debate that. But right now, this market is not seeing any rate cuts until probably the back end of the year, at least December time. And we're going to begin to talk about the prospect of hikes. It runs at 15% at the moment. That is a ratio that is moving.
Yep, 30 basis points, I think, is roughly the number of cuts priced in at this moment. We also have some stocks we're keeping our eye on, Manus, some earnings to get through. Barclays in London, plunging the most in 6 months this morning. The British bank falling currently 5%. It left its earnings guidance for the next year unchanged.
Nestle shares rising the most since 2009 after the sales growth at the world's biggest food maker edged up from historically low levels. That was in the final quarter of 2024.
And finally, a check on Reddit in the pre-market session. Those shares are dropping nearly 14.5%. Fourth quarter user growth missed expectations. Reddit now struggling to keep up with its peers.
And in just a few moments, we'll catch up with Edward Cole of Man Group. Later in the hour, Mark McCormick joins us from TD Bank. Danny, the question is both geopolitical and tariffs. Geopolitics, there's a peace dividend spreading at the moment in the euro and in European stocks. But how much of that permeates back to us, or is it more a dollar story for us as Trump and Putin are set to meet in Saudi Arabia?
I think that's a great point. I'm really looking forward to speaking with all of our guests this morning. But Mark McCormick has this line that I love, that markets are serial monogamous. They can only concentrate on one thing at a time. How do markets do that when there are so many things happening at the same time? And often, as you point out, with the euro, opposing forces.
Well, look, it's a Herculean force. We're expecting, could be today, could be tonight. We don't know when the next level of universal tariffs are going to be announced. And then the bond market's got to grapple with, well, what is 3% inflation? I like what Julian Emmanuel said yesterday. It's not the 70s show. In other words, it's not that moment of where you've got politics and the bond market in deep conflict. That was Arthur Burns and Nixon.
I think to that point, it's really instructive to see what the curve did yesterday. You assume it would flatten if CPI comes in hotter, that the front end would go up. It was actually the long end that had the majority of the losses, which seems to suggest it's not a higher for longer environment we're pricing, it's a higher forever environment we're starting to price.
Well, I wonder how risk assets grapple with that. Let's take that very question to Man Group's Edward Cole. He's weighing in on the trajectory of inflation. And he writes this: look, the bond market seemed to have got the joke that inflation is moving higher in the US. Two-year break-even inflation, and the US has more than doubled from a low of 1.47% to 3.1%. I'm pleased to say he's the head of multi-strategy equities. He joins us now. So the bond bears, they really had the last laugh yesterday. They pushed the long end. They took the hit. They hit the sell button on the CPI. But the question for you in markets is, rate cuts being pushed out to December, how does maybe one cut, no cut, really impact the risk trajectory for you?
Yeah, I think the question is not about one cut, no cut. I think the question is really about the extent to which there's a probability of a hike. I think, what we know is that it's policy that kills bull markets, and really we have to start to ask ourselves what's going to force the Fed to hike here. And my tendency is really to approach that by thinking that the bar is very, very high indeed. I mean, we've been thinking about, since September last year, before we had any real idea about which way the election would go in the US, we've been seeing signs that inflation would move higher. That's been driven, I think, much more by demand side than anything else. And, since over the last few months, the high-frequency data has come out to support that view, both on the labour market and more cyclically. But against that, I think it's pretty unlikely, actually, that the Fed is thinking about hiking. And the reason I think, or one reason to think in those terms, is that if you think back all the way back to October 2020, the Fed introduced average inflation targeting regime, which is not talked about anymore at all. But It's possible, actually, they've kind of, de facto continue to endorse that, and that they are moving gradually over time to a higher inflation target without telling us that they are. And if they continue to do that, that they will tolerate inflation above 2% because they are mentally anchoring to an environment now where they're making up for that inflation undershoot that went on for so long previously. So what all that means is if we don't have a hike, I don't really care that much whether it's 25 basis points or zero. I think what we then have to think about is how do you position for a world where actually a bull market can continue, inflation maybe runs a little bit hotter, the cycle is re-accelerating again, and I think there's some really interesting ways to think in stock markets about how you would take advantage of that.
Well, I can't just leave that hanging there, Ed. How would you take advantage of it?
I was going to leave it there. I thought we might be out of time. I think so. The first thing to think about in US markets is cyclicals. Cyclicals versus defensives, both in the US and Europe since the Q2 last year have done pretty poorly, much more poorly in the US than in Europe. And I think part of that in Europe has been this big catch-up over the last 3 months, some of which is probably early discounting of the potential for an end of the conflict in Ukraine. But in the US, cyclicals have underperformed defensives by about 18% since Q2 last year. And I think there's room for that group to catch up. In particular, if you look at the relationship between data releases and earnings revisions, I think it's notable that Russell 2000 earnings revisions tend to follow new orders in the manufacturing ISM, and we had a big print there in the last data that came out. So that's one group I'd look at. Another area that we're really interested in is weak dollar beneficiaries. To my mind, the dollar is still a trade that's got plenty of room to give back, and I think inflation and policy rates are part of that. Notably, what I mean there is that as real yields move lower, which was in the quote that you showed from me at the beginning, as real yields move lower, and if the Fed is not inclined to hike, then nominal rates don't go up much, then all things equal, that's probably weak for the dollar in an environment of a cyclical re-acceleration. So then where are your weak dollar beneficiaries? Well, the biggest one for us, I think the biggest conviction for us for multiple reasons, but the dollar's a big tailwind in it, is EM Asia, emerging markets in Asia. And I think the additional tailwind that area could have is the tendency for some type of accommodation to be reached probably quite soon this year between China and the US, at which point we think there's a possibility that Chinese policymakers reinforce what they said last year when they did their do whatever it takes moment, and we start to see some of the really big structural reform coming through in China that will unlock consumption and start to see these fears of deflation fading there.
And this goes to the risk. We've seen Europe lit up. It's up 8% relative to the US, but you say the asymmetric risk for China, it's compelling. What do you need to see from China in a policy response to make it compelling and investable, fully investable?
Yeah, I mean, so look, there's a few things in that. I think the first is, and it feels like it's an age ago already, but DeepSeek, we didn't expect that. I don't think anyone did, but it's a real clear reminder that actually, while all headlines have been focused on China's deflationary shock over the last 2-3 years on the one hand, and US exceptionalism in everything on the other, that actually quietly, not so quietly there's been an enormous amount of technological innovation in China, which is now, competitive on a global scale. And I believe that those things are poorly capitalized in China versus the rest of the world. So that's one thing. It's just a recognition that actually there is opportunity that is much deeper than just thinking about, a single metric like deflation in China. So that's one. But then the second is policymakers continuing on that kind of trend towards structural reform that will take some of this downside risk away. And I think the thing that
Ed, to
we're
that
focusing
point,
on
if I can just jump in here, because the DeepSeek news had a very, very temporary impact in the U.S. As a matter of fact, most headwinds have. But underneath the surface, you have seen it appears to be a sentiment shift. The latest AAII survey shows the most bearish on equities since November of 2023. Is there a shift, this kind of uncertainty that we're getting from policy? Has something changed in the animal spirits of this equity market?
I think something changed quite a long time ago, and I think just through all the kind of hype of the specific leaders in the semi-cap space, we kind of lost sight of it. But, the semiconductor in the US peaked versus the market in July last year. This has been going on for quite a long time. I would probably counter a little bit on your point that DeepSeek was short-lived. It was short-lived at index terms. It was not short-lived for some of the single securities. So I think the disruptive effect is not necessarily just like in thinking about indexes. It's in thinking about individual companies and opportunities there.
Yeah.
And I think, back to that point, we do think that China has used this period of, relative containment over the last few years to really double down on making more with less. And this is just a manifestation of it in one area. But there are other areas as well in smart manufacturing, in other parts of the economy where
fair enough, Ed. Yeah, again, and it's a disruption that U.S. equity markets are going to have to grapple with. I'm afraid that's all we have time for. Ed, it's always really fantastic to have you on. One of the smartest people to join us, Edward Cole of Man Group. Let's get you some other stories now that are trending on the terminal this morning. Sources say KKR is considering investing in Nissan after the struggling Japanese automakers' talks to combine with rival Honda failed. Although the talks are dead, Honda and Nissan will continue their strategic partnership and collaborate on the in-house development of batteries and EV technology.
The UK registered unexpected growth at the end of 2024, with GDP rising 0.1%. Economists were expecting a drop of 0.1%, which would have posed a threat of recession after a rough start to 2025. Despite the growth, the underlying picture shows private sector per capita output shrinking for a second straight month.
Alibaba chairman Joe Tsai has confirmed that iPhones will now use their AI technology. The partnership could help Apple revive iPhone sales in China, where they have suffered. He spoke at the World Government Summit 2025 in Dubai.
Inside China, because of regulatory issues and things like that, they need to work with Chinese companies that develop AI. So Apple has been very selective. They talked to a number of companies in China, and in the end, they choose to do business with us. They want to use our AI to power their phones.
Coming up, peace talks cause tension. President Trump and President Putin are set for a negotiation over Ukraine. The details next on Bloomberg.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia. The first time we'll meet in Saudi Arabia, see if we can get something done.
Certainly not a betrayal. As I said to our allies yesterday, we recognize the incredible commitment that has been made over many years, and no country, as the President Trump has pointed out, has made a larger commitment.
U.S. Defense Secretary Pete Hegseth defending Trump's diplomacy after the president began to arrange Ukraine peace talks with Russian President Vladimir Putin. The president gave no indication whether the EU or Ukraine would be a key part of those negotiations. Joining us now to unpack is Bloomberg opinion columnist Mark Champion. Mark, the former British Foreign Secretary James Cleverly, after this news was announced, wrote out, starting a negotiation by setting out what one side should give up is not a strong move. Of course, referring to Pete Hegseth, saying that it was unrealistic for Ukraine to have its pre-2014 borders. What does the setup look like for a possible peace deal?
Yes, I mean, we don't know still what is in Trump's mind and what his exact plan is in terms of how he sees this unfolding. But it is clear, I mean, he is a very seasoned negotiator. You know, whether he is the best in the world, as Pete Hegseth said, is another matter. But he's a very seasoned negotiator. So if his goal is to negotiate, to pressure.
I think we might have just lost Mark there, unfortunately. Again, Manus, the conversation at the moment, we will try to get him back. The conversation at the moment is what exactly does a deal look like and how involved is Ukraine? They haven't really said, or Trump hasn't said, as to whether they would be involved very much on this. And we know he's
No.
meeting with Putin in Saudi.
Not at all. And this goes to the point, it's about a realistic assessment. Hex has said this is about a realistic assessment of what's going on the battlefield. Then you look economically within Russia and you begin to assess. Both sides have a great deal going on here. But let's just return to Mark. He's back with us at the moment. Mark, continue your thought. We were setting the stage in terms of, I suppose, what Hegseth has said, a realistic assessment on the battlefield. We're not going back to 2014 borders. NATO's off the table. So, as to Danny's point, in some ways, showing the bottom line at the moment before the negotiations even begin.
Yes, so this will be very worrying for Ukraine. It'll be worrying for Europe. Europe was completely left out. Ukraine, in a sense, also.
Okay, we are having those technical difficulties. We'll try and get back to Mark. We'll certainly come back to this, of course. Many issues to be discussed. How do you develop the security concerns with troops? Will that involve European, non-European troops? What role does the US play? We'll talk about that through the show. Let's talk about President Trump. He's also got other issues on his agenda. He's meeting his Indian counterpart today, Prime Minister Narendra Modi. He's meeting and the expected, to be later this week. Here for an update on what's going on in D.C. is Kevin Whitelaw. Kevin, look, 5 years ago, this was 100,000 people, with Trump and Narendra Modi. It was a fanfare. But what is different now? Because we're seeing Modi actually on the front foot, perhaps making some concessions before the meeting.
Yeah, no, it is a very different atmosphere this time, much more celebratory and warm last time. And this, now we're going into it with a Trump administration that's really intent on reshaping sort of global trade relationships. And when Trump is now looking around at how other countries are handling imports from the United States, India is actually a pretty high tariff country. They have pretty high tariffs on U.S. goods coming into the country. And so, with where Trump is trying to do that, that makes India a real target and puts them in a pretty weak position as they come into this early meeting with Trump. So interesting that he's coming so early in Trump's presidency, but yes, he's under intense pressure to impose to come up with some concessions before Trump potentially imposes these reciprocal tariffs that he's been talking about, which would hit countries like India harder than most.
Again, it's a fire hose coming out of Washington, D.C. Trump has lived up to the promise that he would act forcefully in his first days in office. And one of the actions that they've been taking, Kevin, is what DOGE has been doing, really trying to slim down the federal workforce. They offered a buyout. It was challenged by a judge. They were given the go-ahead. What do we know about the Trump administration's power to let go federal employees?
Right. Well, the buyout does seem to be proceeding, but obviously it's going to proceed with a much smaller number of people signed up than Trump had originally and Musk had originally estimated. So instead of, millions or a million or two, it's, in the sort of 70, 80,000 range, it seems like, assuming it moves forward as it's set up. So that's a drop in the bucket for the federal workforce, of course, and that then is going to raise some difficult questions down the line if Trump tries to go through and do sort of broader layoffs. That's where various civil protection rules come in, civil service protection rules come in. And that's a framework that various folks in Trump's orbit have suggested they really want to try to change, something that is going to be challenged in court if he tries to do that. But obviously, what I think this administration has shown is it's ready to move ahead and then try to make everyone else catch up with it and cope with it. And so far, Congress has not weighed in at all, and it's unclear that it will. And the courts will have to obviously decide how to play it, but that's a slow-moving process, and Trump moves a lot faster than any of them.
Kevin, that is the perfect way to characterize it. Everyone just playing catch-up. We appreciate it. As always, Bloomberg's Kevin Whitelaw. Man, it's a quick check on commodities. This in direct response to the peace negotiations happening in between Russia and the U.S. over Ukraine. Brent crude down by 1 1/3%.
Yeah, of course, Trump-Putin, to me, not in the distant, not too distant future, Danny. We saw this biggest drop in 2 months yesterday, and then add into that, you've got inventories rising, and you've got calls on OPEC to do more. So it's at multiple fronts here. Imagine Russian oil, the sanctions, what scale of sanctions will be lifted, and how quickly will that oil come back to the market? Front pages for you from around the world. First up, New York Times leads with New York City Mayor Eric Adams has discussed running as a Republican for re-election. Conversations ramped up around the time that President Trump's Justice Department ordered the prosecutors to drop the corruption charges against him.
Next up on the Journal, the Trump administration is suing New York State over 2019 law on undocumented immigrants. The law allows them to obtain state identification while shielding their data from federal authorities.
And the Financial Times reports Wall Street banks are close to selling $3 billion worth of loans backing Elon Musk's takeover of Twitter. This comes as the bankers, led by Morgan Stanley, successfully sold $5.5 billion worth of debt tied to the takeover. It's a marketing man's dream in investment banking. Quick snapshot of what's going on with the pound. Of course, we had that unexpected nice pop-up in growth by 0.1% in the fourth quarter. But, of course, on the per capita, the private sector per capita, Danny, shrank for a second straight quarter. So that's just something to be aware of there.
Yep, coming up, we're going to talk more FX. Mark McCormick of TD Bank joins us next. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
The prospect of peace boosts risk appetite. Euro strengthens, oil drops, with Presidents Trump and Putin set to meet in Saudi Arabia. Charting next steps, a U.S. delegation heads to Munich for a security conference and gears up for a meeting with President Zelensky. Close, but not there. Chair Powell says there's more work to do, bolstering the case for the Fed to hold. Jobless claims and PPI up next on the slate. Danny, good morning.
Good morning. And to start yesterday morning, it was about too hot inflation. But the news that U.S. and Russia are starting negotiations over Ukraine means losses are paired, and we are little changed this morning. We are still below. We are just 1.09% below all-time highs for the S&P 500 futures. For your bond market, after that strongest monthly print since April 2023, U.S. Treasuries saw their biggest jump in yields of 2025 so far. They go down today by 2 basis points, still above 4.6%. But there's the Ukraine peace talks impact, Manus. It is a euro that is stronger, and NYMEX crude down 1.5%. Mark McCormick, though, of TD Bank, weighing in on the impact of tariffs, writing, "We have been flagging to clients that the risk of tariffs is underpriced by the FX market, by the U.S. dollar on dips when positioning does not look stretched, and when markets seem too quick to price out tariff premium." He is the global head of FX and EM strategy, and he joins us now. Mark, that's all well and good, but as you say, these markets are serial monogamous. How do you play that when you also have forces of geopolitics, of Ukraine strengthening the euro, along with inflation and tariffs to cap it all together?
Yeah, there's definitely a lot to unpack. I think the first thing is to try to figure out what the major signal here is, and whether or not the markets are driven by fundamentals or whether or not they're driven by some external force that we can't really measure. We'll call it a residual. But I think that the key thing here is that the underlying fundamentals in the FX market have been driving it for the last 6 months. And I think as we saw in the data yesterday, one of the things that we do is we look at these quantitative strategies, we look at factors, and what we're seeing is our growth and our inflation factors are doing very well in terms of performance. They're generating upside, and what we're seeing is those are correlating with the stronger dollar. So that's a very simple way of saying inflation and growth matter, and inflation and growth favor the dollar. And I think when you layer in all these other things, the uncertainty around trade policy, the where we're going on deregulation, the way the world is kind of pulled together in what we call geomacro, those are upside risks to the dollar, even if we don't realize the downside risks of a trade war, or again, if a lot of this is more rhetorical, again, the dollar is a growth currency that has elevated inflation that you're getting paid carry to hold.
So, Mark, if we look at the dollar, you've got inflation, growth, rates, and capital flow, all the floors for the dollar. You then look at the offer side, this building narrative about Trump-Putin meeting, a de-escalation possibly. We have Hamas and Gaza, a ceasefire that's holding, but there's a clear velocity on geopolitical resolution. I asked Kit Jukes this question last week. I ask it to you. Does that cap the dollar, or is that a pressure taken off the dollar and we drop as a result of geopolitical resolution?
That's a great question, because I think it comes down to market positioning. So, essentially what happens is we get slammed with news flows. The market tries to figure it out. But really what matters is the base effect of where was the market positioned ahead of the news. And again, a lot of this can be very short term. It can be very tactical. But, for us and the way we talk to clients is where are we going the next 3 months, the next 6 months, the next year. So the point that I would illustrate right now is our positioning indicators have been trying to sell the dollar since January. And so we've seen a rotation, at least over the last couple of weeks, where we're building up dollar shorts. We're seeing the markets move back into EM carry, the market build longs back into the euro. But again, I think this is just a natural process that the pendulum swung too far. Trump wasn't super aggressive on trade, to come out in the first week, the first couple of weeks, and it's been more scattered news. So I think what we're seeing here is this is really just a positioning drawdown. But again, where we're going in the longer term is really, again, tied to the fundamentals, tied to the tariff story, tied to the outlook for the global economy. And the thing that I think is a little bit alarming right now is if you run some of these global indicators, we are seeing a higher rise in inflation when it comes to a diffusion indicator globally versus a higher rise in growth. So the world feels like it's in a bit of a stagflationary environment. And the other thing that I would highlight is, in spite of the positioning where, the news looks like you should sell the dollar right now, if you look at trade policy uncertainty and macro risks and geopolitical risks, macro volatility is subdued relative to where those indicators tell us. So these are things the markets are not good at pricing in. And so, again, looking through the models that we have, what we're seeing is a lot of the uncertainty, a lot of the trade policy uncertainty is not priced in. So I think this is a big fade in terms of, whether or not you should be selling the dollar right now.
How should it look if it were to be priced in, Mark? Let's just take the euro, which, as we've been talking about, has been strengthening as of late at 104. What should that currency pair look like if you were to actually price in tariff risk for the European continent?
Yeah, I think that should get us closer to parity. I think it's that simple because it comes through multiple channels. We've gotten this question a lot. In 2022, the last time euro reached parity, there was a clear catalyst. It was actually the start of what might be ending relatively soon. So people would be wondering, well, what would it take? And I think what we're seeing here is it's death by 1,000 paper cuts. It's not just one factor. And as you noted, the news flow it's kind of all over the place. One day it's tariffs, one day it's trade uncertainty. Now we're talking about foreign policy and geopolitics. So I think the thing is it's growth, it's inflation, rate differentials, it's equity returns, which again should turn in favor of the dollar once we start to look at deregulation and some of those other factors that are more positive for the U.S. relative to Europe. Again, it's the carry that's being offered. So what you're seeing right now is the market is putting a lot of weight on positioning because they're headline trading and everything's very tactical. But all those fundamental forces, plus the uncertainty of where we're going in the next 3 to 6 months, are a multitude of different forces that in our quant framework and the strategies that we run are all basically bearish for the euro. So I think it's a combination of all those things that when you add them up is a much bigger story than one individual factor driving the euro.
Mark, thank you very much. Lean into the dollar. Take your opportunity. Mark McCormick there at TD Bank. Coming up in the show with Danny and myself, the US and Russia agree to begin talks on Ukraine just ahead of the Munich Security Conference. The details to come on Bloomberg.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia the first time. We'll meet in Saudi Arabia, see if we can get something done.
Certainly not a betrayal. As I said to our allies yesterday, we recognize the incredible commitment that has been made over many years, and no country, as the President Trump has pointed out, has made a larger commitment.
U.S. Defense Secretary Pete Hegseth defending President Trump there at the beginning of the arrangement of these peace talks with the Russian President, Vladimir Putin, without seeming to involve Europe. President Trump said he had asked Secretary Rubio, CI Director John Ratcliffe, National Security Advisor Michael Waltz, and Special Envoy Steve Witkoff to lead these negotiations. Pleased to say David Gura is with us, host of the Big Take podcast. David, good morning to you. So this is very much framed at the moment, excluding other parties. This is America and Russia. Europe has been benched, and Ukraine got a phone call. This must be deeply worrying to the Europeans.
Absolutely. And so this is happening right before the start of this Munich Security Conference, where a number of these world leaders are going to be gathered. And I think what's crucial here is that nobody was tipped off to the fact that this was going to happen. And obviously, if you look at the policy of the past administration, it was no Ukraine without Ukraine. They had to be at the table for any conversation about the country's future. That wasn't the case here. So the conversation between Vladimir Putin and Donald Trump took Europeans by surprise. And I think for a lot of observers, those who are both leaders of those countries and policy experts, what they worry about is that Donald Trump has given away some leverage in doing this. He has had this conversation, lasted about an hour and a half, indicated, as you said, that they plan to meet perhaps in Saudi Arabia somewhere in the coming months. He's kind of giving the contours of what that negotiation might be. And for so long, what the Biden administration argued was you couldn't do that. There had to be leverage brought to the table, in part sanctions policy, whatever it may be. Now that seems to have dissipated. And I think worries Europe what might happen. And we have this Bloomberg economics analysis now that reconstruction could cost $3.1 trillion in Ukraine. So Europe is now having to reckon with the fact that Donald Trump could walk away from this deal. He could decide that much of this should be shouldered by Europe. It really changes the economic picture for European countries.
Well, speaking of that, you also have Pete Hegseth and Donald Trump saying that perhaps the new target for NATO spending should be 5%, not 2%. How does this all factor in when you have European economies already struggling, plus the threat of new tariffs?
It really heightens the difficulty, needless to say, and you have a defense mechanism in Europe that isn't sort of up to speed yet on being able to make the kind of ammunition and weaponry that they would need, that Ukraine would need here going forward. So Pete Hegseth, again, before this Munich Security Conference, going to Brussels, laying out sort of the broad contours of the plan that the Donald Trump administration has here when it comes to Ukraine. Suffice to say, I think it's going to upset a lot of people who are there in Brussels and will be at that conference as well. And so the most senior member of the Trump administration is going to be there is J.D. Vance, the vice president. We'll see what the reception is going to be for him when he gets there.
This sort of adds to the narrative in the press at the moment is that the president sees the Europeans just as a cash register to tap and pay. But when it comes to security, I think it's interesting what Hegseth said yesterday. European and non-European troops, didn't mention U.S. troops. This will be a non-NATO mission, not under Article 5. These are all the things that Zelensky, he may not get NATO administered into NATO, but these are all the things on security guarantees that Zelensky has said that he needs and wants.
Has to be incredibly sobering, all of this happening to him. And indeed, as you said, President Trump did speak with him after that phone call with President Putin. But these are things he hasn't been shy about wanting and saying that Ukraine needs going forward here. So even NATO membership, it's something I think a lot of people were wondering what the timeline for that might or might not be. But to not have that on the table is something that's going to be deeply dispiriting and difficult for Ukraine going forward here. And that 5% threshold is something we've heard from Donald Trump before. Obviously, this is something that it's a horse that he's beaten for a very long time, that Europeans should be putting more of the equivalent of their GDP forward to NATO. But again, I think it's going to catch a lot of them off guard that it's happened this quickly and this abruptly.
If we can bring it closer to home, one of the tensions that's also playing out in Washington is just how much power Trump and DOJ has in firing federal workers. We saw the judge give the go-ahead for that buyout offer. The DOJ, CNN reporting that they also want the Supreme Court to take up Humphrey's executor, which essentially bars the president from firing federal officials without cause. It seems like this is heading in kind of one direction. David, is there any real pushback to the president's authority in firing folks on Capitol Hill?
So what we had with that decision from a Boston judge yesterday is him effectively saying that those who brought this case against the administration had no standing. And so we go back to this buyout, this fork in the road buyout that Elon Musk and others offered these workers. Only 75,000 of them took them up on that deal. And I think that's something that stands out to me, that the goal of the White House was to get 5 or 6% of federal workers. And of course, it's a huge workforce to go along with this buyout. They didn't. But you're right. I think it is going in one direction here. There was an executive order yesterday on the Foreign Service indicating that they effectively have to get behind the president's agenda here. And I think you'll see a lot of pushback from career members of the Foreign Service who say that the point of that job is not to be the kind of political behest of the president. This changes that notionally. And we'll see if there's pushback on that side as well.
David, we really appreciate you joining us this morning. That is Bloomberg's David Gura. All right, from geopolitics to the rate path to AI, investors are looking at a lot of potential market risks ahead. Bloomberg's Sonali Basak spoke with the Diameter Capital Partners' Jonathan Lewinson on his outlook on the latest edition of The Next Big Risk.
Look, the world is teeming with misinformation. It's deepfakes, it's AI, it's hard to work through. At the same time as this is happening, political identity is paramount, which means that people's political affiliation matters to their self-perception more than ever. And that doesn't only mean what their values are for the future, it's about what they think just happened. It's a debate about facts. Wall Street is supposed to be an island of objectivity in all of this. If earnings are good, the stocks go up. If earnings are bad, the bonds go down. But Wall Street more and more is adopting unmarked assets. Private equity, venture capital, private ABF, private credit. Those things aren't marked. Mark to market is what creates the need for honesty. And to me, the next big risk is, in this sea of subjectivity, in this changed environment, will investors really know what they own? Or does everything become Silicon Valley Bank and Lehman Brothers?
How does that make the job of an investor more difficult?
So let's step back first and play an experiment. I was on a trip recently with my 13-year-old son, and we saw a bumper sticker that said, "Inflation is a hoax." And he turned to me and he said, "I get misinformation." But he said, "Why would someone say something that you can see, like prices going up, is a hoax? What are they accomplishing?" And I laughed. But in reality, on Wall Street, as investors, we often rely on surveys of what people are saying in order to have a sense of leading indicators. During the election, it was Republicans who thought inflation was a problem and Democrats didn't. Now, magically, in January of 2025, it's flipped. And Democrats think inflation is a problem and Republicans don't. But it goes even beyond this issue of inflation that was a big one in our last election. We, for a long time, rely on just surveys of consumers, on CEOs, to tell us how things are. It helps us invest. It helps us understand the macro. And they used to be very, very valuable. But about 10 years ago, it changed.
If you're looking at an American public with two different views of the world, then how does that factor into decision making?
Well, we all know that from 22 to 24, everyone was obsessed with a recession. And it made a lot of sense. We all learned in school that if there's high inflation, rates go up, and therefore you have a higher probability of the economy slowing or contracting. But over time, what we saw was that hard data was doing okay. The economy was performing well. The soft data, particularly CEO surveys, didn't catch up with it. In prior periods, when there was worry about recessions and they were disproven, or by hard data, the soft data caught up, and it didn't this time. And in fact, when I would meet with senior investment bankers, I always asked them the question, what are the CEOs saying? Because they should have better insight than any. And throughout 22 and 23 into 24, they all said the same thing. CEOs tell me that their companies are doing great, but they're expecting a recession.
Hot off the press, Shonali Basak is with us now. Shonali, first of all, really great work, as always, in The Next Big Risk. That's really interesting what he was just talking there, Lewinson, because it's something this market has been grappling with. The differences in sentiment between different types of people. How do you see that? How did he talk about that playing into his world?
Yeah, he named a few different metrics, and you saw this, for example, with the University of Michigan data and other types of consumer surveys. You saw the difference between how Democrats and Republicans felt about inflation, and it was drastic, and it changed drastically after the election. Another example he started to give there was about CEO sentiment, and a survey that had showed most CEOs are Republican, and you saw them change their minds about how they felt about recessionary forces under different political atmospheres. So he's saying that if you are working off a base where the information itself is politicized, and then you have that overlay of misinformation that is pervading the system as well online and in other places, then how, as an investor, are you supposed to make decisions? You compound that with the fact that many assets are now private and unmarked. And he says that mark-to-market aspect is forcing honesty in markets, and without it, that honesty is not as there.
Do you think we're in a more robust, from the discussion, great work, by the way, are we in a more robust mark-to-market transparency on assets relative to we were in the GFC? Because the whole crux of the edifice of finance was that things were not marked properly, they were not priced properly, and that was part of the core.
It's great that you bring that up. He also brought that up, another Lehman moment, another Silicon Valley moment. He said the only thing this time around that's really different is the leverage and
To be clear, I'm not calling another Lehman moment. There you go, just in case anybody...
Risk. And the reason that's a risk is because of what you're saying, is the opacity of these markets. Now, as you both know, that there's also a debate going on very, very aggressively underneath the private markets about whether these assets should be more liquid. You have Apollo starting a trading desk for private assets. That would force more marks to these assets, and others like Blue Owl saying that they're not going to participate in that type of trading of private assets. They're private for a reason.
Well, surely, okay, Lewinson says that you need more mark to market, but for a lot of managers, that must be alarming, who could hold up these valuations because they didn't have to mark.
It is particularly interesting coming from Diameter, because Diameter both trades in public credit markets. They've become a real giant in this space, but they also have started a private credit arm as well. So they've been seeing both sides of this argument. Now, another interview we did for the series was with Josh Easterly over at 6th Street. He's a co-CIO there, long time in these private credit markets. He's also concerned about this kind of mark-to-market issue, mostly because he thinks a lot of the talent pool that is coming into the world of private assets are not used to this dynamic. He says just because they're not marked doesn't mean they can't have wild swings in valuation. And so there is a recognition that the prices are changing, but you're not seeing what those marks are.
Shanali, great work. Look forward to more of it. That's Shanali Basak there. And you can see the full interview of the next big risk. It's on the Bloomberg terminal and Bloomberg.com. Pick it up, have a watch. It's pretty worthwhile. Coming up in the show, we've got some economic data, we've got some earnings for you. We'll set the agenda and your slate for the rest of the day.
It's your Bloomberg Brief. Danny Berger and Manish Craney in New York. Let's get you set up for your trading day on this Thursday. Deere will be reporting first quarter earnings. That happens before the bell. And another round of data, jobless claims, PPI. That's at 8:30 a.m. Eastern. We also have an auction, Manish, $25 billion of 30-year bonds at 1 p.m.
Let's see, do they roll up for those real long duration? Some stocks to watch, Danny. Cisco reported after the bell. They're gaining this morning, boosting their revenue forecast. That's a nice win for them. Royal Caribbean up 2.25%. They approve a $1 billion buyback, and they're boosting the dividend. And then on MGM, look at that, up over 9%. Good earnings. They beat with strong Las Vegas bookings. We're off to Las Vegas, Danny. Help MGM. Hey?
All right, I'll see you there, Manis. Let's get a quick check on currencies. I don't know how to follow that up, I'm being honest. Let's get a quick check on currencies this market. The euro is strengthening, but at what point does the jubilation over a possible deal on Ukraine-Russia meet the fundamentals? Something Mark McCormick was arguing over at TD. And this from ThyssenKrupp, Manis, the CFO warning that tariffs on steel could prompt a flood of cheap Chinese steel into Europe. It is the fundamentals that might end up reshaping and weakening the euro.
And that's what Europe needs to defend against. And the subplot to the US tariffs, the 25% tariffs, is more about the China flow into the world. But going back to where we are with the euro dollar, up a third of 1%, Mark McCormick really was saying, look, we've come back to neutral. This is not a stretched dollar position. You can go and you should lean into the dollar here, was his basic tenet, because we're reacting more to growth and inflation data. Surprisingly, you get that initial boom on the headlines, and then it's back to reality. What's the growth? What's the inflation? What's the data?
It does feel like we've had a sentiment reshift, a restart after the Trump boom in general. Mark McCormick talked about the dollar, the latest AAII survey of individual investors in this equity market, the most bearish Manis since November of 2023. Perhaps it's that policy uncertainty really coming to bite, and inflation at the hottest in some time.
Well, as we just heard from Man Group, it's not right. It's not. Hikes are what kill bull markets in equity. So we keep an eye on that. We turned it around yesterday. What can we do today? That's it from us. We'll hand it over to the surveillance team. They'll take you through the next couple of hours on Bloomberg.